Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, November 29th, 2022. Starting with our economic release spotlight, just wanted to highlight some of the inflation data that's come out of the Eurozone this morning, preliminary prints out of Spain and Germany. So, Spain headline CPI decelerated 70 basis points to 6.6% year over year. That's the lowest print we've seen since January in the Spanish economy. And then Germany came out at 8 with a 30 basis point deceleration to 11.3% on a year-over-year basis. That's the fastest deceleration we've seen since June. So we had two downside surprises in European inflation data this morning. It's our view that the stickiness of inflation in the Eurozone pales in comparison to the stickiness of inflation in the US. And we can observe this very eminently by the massive spread between headline CPI and core CPI in the Eurozone. It's right around 560 basis points versus headline CPI and core CPI in the US, which is, I think, 146 basis points. So it's our view that this sort of this move in markets, this move towards Goldilocks, dollar down, rates down, everything up, we think that's premature. We think the markets are going to get, for lack of a better phrase, punched in the face, this week by the data. We got inflation data on the PCE side on Thursday. We got JOLTS data, I believe, on Wednesday, and then we have the jobs report on Friday. And ultimately, we have a lot of Fed speak, including Powell on Wednesday that we talked about yesterday. That could sort of jive with what our belief is that the markets have gotten a little bit ahead of themselves. But we'll see. You got to make it, like I said yesterday, you got to make a call. You got to position on, and the call has to be correct for you to make money in financial markets. We're not one of these programs, of which there are many. One of these programs that just is always right. No matter what happens in the markets, they're always right. Guess what? It's very easy to be always right when you don't make calls. And guess what? We make calls here at 42 Macro because, again, our main priority is to help you make and save money. Speaking of helping you make and save money, let's just turn it over to my Longbow dashboard this morning, getting into the global macro section. US dollar, that's bearish from a short-term price window perspective, bearish from a medium-term perspective. Again, I do think these might be a little bit premature, as I highlighted. I don't want to fight the tape, but again, the tape changes, by the way. You got to forward-looking views that might cause the tape to change. And so, again, I do believe the tape here on the dollar index is likely to change. You're now starting to see it base and bottom. I highly doubt we see significant new lows from here, just given some of the dynamics we expect from a Fed reaction, an ECB reaction function perspective over the next few weeks. Gold, that's bullish short-term, medium-term price momentum, middle of the range, 10-year treasury, bearish short-term price momentum, bullish medium-term price momentum, middle of the range as well as there. S&P bullish on both durations, getting towards the lower boundary of the range there. But again, I think this lower boundary is a mirage. To be quite frank, I'm rarely as frank as I am now. But again, we 42 macro subscribers understand full and well why we are being so frank, given some of our views on inflation, the stickiness and stochastic nature of that process, as well as well as our implied views from that inflation on net liquidity. Again, if we're wrong, then our views on net liquidity is going to be wrong, then our positions are going to be wrong. But guess what? We don't expect to be wrong. I don't wake up early and stay and grind till my fiance tells me to come to dinner every single day, expecting to be wrong. I'm a former athlete, former high performing athlete, as you can see that very long list of accolades from the gridiron. I understand what it takes to be successful, and so we understand that success is not given, but you got to work hard, and we do. Anyway, VIX bearish on both durations here. That's getting towards the upper boundary of the range again, much like the S&P's lower boundary of the trading range. We think the 2419 is a mirage, in so much as we thought this thing wouldn't get much below 20, which is pretty consistent with the lower boundary of the range you typically see in bear markets. Nasdaq bullish from a short-term perspective, neutral from a medium-term perspective. That's towards the lower boundary of the range as well. We also think that is a mirage as well. What else here? Russell 2000 neutral short-term price momentum, bullish medium-term price momentum. So that Russell's been bullish for a while now, at least a month, and now it's breaking down, at least on a short-term basis, to neutral price momentum. And again, this is what happens when markets start to trade sideways for a matter of weeks, because again, they're losing that mojo, losing that upside. The willingness for people to chase, the Russell 2000 well beyond $18 or 1,800, or S&P 500 well beyond 4,000. In our opinion, is very much reduced. And we talked about this in our last couple of macro scouting reports. But we went from dating for our the new cute hot girl on the block, which was, or sorry, not the new cute hot girl. It was the Gretchen Wiener. For those of you who are fans of what's that movie? Now I'm blanking on the movie. Damn, I'm getting old. Mean Girls. Yeah, the Tina was Gretchen Wiener. You know, and then you had the Lindsay Lohan's character come in, and she became the new cute girl on the block. And Lindsay Lohan is Tara. Tara is there are reasonable alternatives now with cash yielding, anywhere between 3.75 and 4% here, and particularly in the U.S. markets. So again, the willingness for investors to chase financial markets, chase seasonality, chase all these sort of things, these narratives, in our opinion, is lower because again, the spread between cash, the yield on cash, and the yield on equities, either earnings yield or dividend yield, is actually as wide as it's been since 2000, and we all know what happened in 2000 and 2002. So anyway, keeping it moving. Bitcoin bearish from momentum perspective, bearish short term and medium term. Same thing with Ethereum, both in the middle of their respective ranges. Shanghai Composite bullish short term price momentum as the we had an interesting headline this morning. The Chinese authorities came out and they're effectively saying, "Hey, look, we're going to accelerate vaccinations of elderly people." And I'm like, okay, well, Chinese stocks are up 2% this morning, but why the hell haven't they done that yet? Is there a reason? Is there a constraint on why they haven't done this very obvious thing to do in the middle of a global pandemic that started on their soil? And the answer is obviously either people don't want to take the damn vaccinations, or they don't have enough, or they don't work in the first place. It's one of those three constraints. So them telling us they're accelerating vaccinations is the dumbest headline I've ever seen reacted to, quite frankly, in my career. I really mean that. I've never seen a dumber headline responded to with bullish price action in asset markets. But that also tells you just how many people are itching to chase the China reopening trade, because again, China is the world's second largest economy that's effectively doing nothing from an economic activity perspective, in terms of incremental growth, and that would be a pretty big upside surprise to global growth expectations, at least in the first part of next year, or maybe even in the middle part of next year. I don't have any edge on when they're going to finally undo zero COVID, but clearly they're starting to take steps to kind of think about how to get out of this, what is very clearly a policy mistake by President Xi. Anyway, lastly, WTI crude oil, that's bearish from both the short term and medium term perspective. If this bullish China price action translates to bullish medium term price action, you're going to start to see crude oil follow in kind, because again, Chinese crude oil imports, Chinese crude oil demand is still tracking down about 20% from its highs. So a fully reopened or marginally reopened Chinese economy it leads to a lot more energy demand, and that's going to be very positive for crude oil, especially in the context of what could be an OPEC production cut tomorrow. We'll see. Getting into my free daily alpha tab before we get you out of here. Sorry for the rants, but I keep getting good feedback on the rants, so I like to do that. So sorted by the odds tab, trying to figure out what's overbought, oversold. We got our friend, actually, it's our friend Bob Elliott's ticker. Bob, what's up, man? How you doing? HFND, this is his multi-strat hedge fund, flagship product over at Unlimited Funds right now. That is oversold. So for those of you who want to take advantage of allocating to Bob's work there, trying to democratize hedge fund like returns to everyday investors, this would be a great example to take advantage of that. And then scrolling down, see what's also oversold here. Oh, we got a lot of oversold signals this morning. Where are we at here? So we got oversold signal in REITs. Don't trust it at all. Get that out of my face. What else? Oversold signal in wood. And so this is global REITs. Also don't trust that at all. Get that out of my face. Oversold signal in the short 7 to 10 year treasury, or no, not quite oversold yet. But again, I would actually be supportive of that. And then lastly, oversold signal in Simplify. Our friends over at Simplify. This is their NASDAQ with downside convexity exposure. Again, I think I would also say, no offense to my friends, get this out of my face as well, because again, I think the lower boundary of some of these sort of risk asset ranges are a mirage at the current juncture in the context of our views on net liquidity, which are born out of our views on inflation and the stickiness of the resiliency and the stickiness of the labor market in the U.S. And so if we're wrong on all that stuff, we'll be wrong. But guess what? We don't expect to be wrong. So catch you back here tomorrow, next time, or same time. Everyone have a wonderful day out there. Cheers.